The market is selling off aggressively, but this time, interest rates are not collapsing. This is the key detail most traders are missing today. In this video, we break down why stocks are falling hard while the 10-year Treasury yield remains relatively stable. We will analyze three indicators: the 10-year Treasury yield, the S&P 500 ETF SPY, and the NASDAQ 100 ETF QQQ. The 10-year Treasury yield is trading near 4.26%. The session shows a controlled move lower, not a breakdown. Yields declined modestly after earlier highs. However, price remains well above the 4% level. This indicates that financial conditions are still tight. The bond market is not signaling easing or stress. In previous sell-offs, yields moved sharply lower as investors rushed into safety. That is not happening today. The lack of a strong bond rally suggests the sell-off in equities is not driven by panic. Instead, it reflects ongoing pressure from elevated rates. TNX remains a headwind for risk assets. SPY is trading near 683. The ETF is down nearly 1% on the session. Price action shows a steady decline throughout the day. Early support levels failed without meaningful defense. Once the market broke below prior consolidation, selling accelerated. There was no strong attempt to reclaim lost levels. This type of move suggests systematic risk reduction. Participants are exiting positions rather than rotating between sectors. SPY weakness reflects a broader loss of confidence in short-term upside. QQQ is experiencing significantly stronger downside pressure. The ETF is down over 2% during the session. The sell-off began early and continued consistently. Each bounce attempt failed quickly. Technology stocks remain the most sensitive to interest rates. Even small changes in yields can have outsized effects on growth valuations. Today's price action suggests sustained pressure rather than a temporary pullback. QQQ continues to underperform the broader market. This confirms a risk-off environment focused on reducing exposure to growth. The market message today is clear. Equities are under pressure. Technology stocks are leading the decline. Treasury yields remain elevated. This combination signals tightening financial conditions without a safety bid in bonds. That increases downside risk for equities. Until yields move meaningfully lower, rallies are likely to remain fragile. Volatility may persist. Interest rates continue to define market behavior.